Okay, why don't we start? We've got a large number of people in the room, and we've
Okay.
got a lot of slides to get through.
All right. Sounds good. Good afternoon, everybody, and welcome to the 2025 year in review. My name is Lorenzo Petrozzani. I'm the CEO, one of the portfolio managers here at Westmount.
And I'm Matthew Evans, the Chief Investment Officer and another portfolio manager at Westmount.
Those of you that have watched any of these presentations in the past know that we like to pick a theme every quarter. And for this year, looking at 2025, we went with a crossing the current analogy. And that's because that's what 2025 felt like for a lot of investors. The waters felt like they was moving quickly. There was a lot of turbulence. Often footing felt uncertain. And there was a real risk of making the wrong move at the wrong time.
Our goal really here is today to walk you through what shaped the markets this year, how our portfolios responded, and most importantly, what does this mean to you as an investor going forward?
So as always, we got to get through a little bit of compliance housekeeping before we get started. The presentation today contains the current opinions of Westmount Wealth Management, and such opinions are subject to change without notice. The material is distributed for informational purposes only and not intended to provide personalized legal, tax, or accounting advice. Investing in alternative asset classes may confer a higher degree of risk and illiquidity and may not be suitable for all investors. Please read the full disclaimer of the presentation for further information. And lastly, Westmount Wealth Management is a registered portfolio manager in BC, Alberta, and Ontario. All right, now that we've dispensed with the formalities, let's get into today's presentation and let's look at what happened for 2025. For most investors, I would say that 2025, and certainly for us as advisors, felt like an unsettled year. It wasn't a crisis year, but certainly not a smooth one either.
And I think that distinction really matters. 2025 really wasn't defined by a single shock. It was defined by multiple forces pulling markets in different directions. And from a client's perspective, that's important because those mixed signals are often harder to deal with than outright bad news.
So as we go through the next few slides here, what we're going to try and do is to explain the three main forces that we felt shaped the markets last year and talk about how we position the portfolios to navigate them and showing how staying disciplined last year was really a crucial skill. So let's get right into it.
No surprise, one of the most important headlines of the year was tariffs. And this chart tries to provide some context to that. So we're not talking about a temporary headline risk here. We're looking at average tariff rates that we haven't seen in decades. So for clients, tariffs matter because they raise costs, they pressure corporate margins, and they complicate central bank decisions. And all of this feeds into market volatility, which we felt. And that saga really culminated on Liberation Day, which was in early April, with the announcement of reciprocal tariffs or custom duties that brought that effective rate. And you can see on the far right hand of the chart here in the orange bar up to 30%. And that's a level that would really jeopardize global economic growth.
In fact, it's a level of average tariffs paid by U.S. importers that we hadn't seen in over 25 years. You can see just how dramatically that could actually 25 years, sorry, 120 years. And you can see just how dramatically that compares. It's not until we look at the early 1900s that we see, that level of tariffs at play. Interestingly enough, though, we saw that it didn't really contribute to inflation and inflationary pressures in the way that we expected to, which perhaps is part of the reason why the markets continued to rally last year and the worst economic fears didn't actually come to fruition.
I would say this, though, at the onset of the announcement, public markets did respond with the S&P posting one of its worst weeks in history. And that really forced the White House to backpedal on the announcement. So the second major force or headline that was often quoted last year was market concentration. And that was particularly focused around what we call the Mag 7. So these are technology-related companies, and they now account for about 41% of the S&P 500. Now, these companies have delivered strong returns, as you can kind of see highlighted in the green area of the box. since 2021, and they've actually accounted for the majority of the return of the S&P 500. I think what else is kind of noteworthy is the dark gray bar that represents NVIDIA. It's quickly become one of the most valuable companies in the world, and that's really thanks to its dominance in the field of artificial intelligence. So to put things in perspective, NVIDIA, if it were its own country, based on its market capitalization, would rank third in the world. So that's only behind the United States and Japan. Think about that statement. That company alone would exceed the total market capitalization of China. So for clients, this is really where the risk starts to build. When fewer stocks drive the majority of the return, portfolios can become more sensitive to reversals.
And it's not necessarily, there's a lot of concern, obviously, about an AI bubble right now. And I've heard a lot of people liken it to the dot-com bubble of the early 2000s. I think there's a difference there. And I think the material difference is when we saw the dot-com bubble, these were companies that were ideas. They had no revenue. When you take a look at, the companies in question on that graph, these are some of the biggest companies in the world, companies that have some of the biggest revenues already. However, there's a lot of growth expectation priced into their stock prices right now. Could they pull back if they don't continue to achieve those growth targets? Absolutely. And what have we done as, portfolio managers to manage that? Well, as you know, for quite a while now, I think over 2 years, we've taken not just a market cap weight exposure to U.S. equities, but we've also taken a portion of that allocation to U.S. equities and put it into an equal weight S&P 500 position. And what that does is it provides more meaningful exposure to large and mid-cap stocks in the U.S. and not a little bit less concentration on the mega cap stocks. What that means is in years where the mega caps, Magnificent Seven stocks do most of the lifting, we will underperform, and vice versa. If we do see a big reversal from those positions, we will outperform. But it is, let's say, a slightly defensive measure that we've put in place in the portfolio to help protect against a reversal should some of this growth expectation start to falter. And we started to see that a little bit last year. If you take a look at 2025, which is that third area of the bar chart, even though the Magnificent Seven averaged 23% last year versus the S&P 500 at 16%, only 2 of the companies in the Mag 7 beat the S&P 500 return. The other 5 lagged. So we're already starting to see a little bit of that, perhaps tempering of expectations there.
The third major theme was focused around central bank policy. So coming out of COVID, we had a large bout of inflation and we saw interest rates rise across the global economies. So one of the major themes here was the U.S. central bank delivering its long-awaited easing, and they cut rates 3 times. That was a quarter point in September, October, and December. And the Bank of Canada cut its policy rate 4 times, ending the year at 2.25. Despite these cuts, it didn't really have the desired effect you would expect on fixed income, where fixed income returns typically work inversely to rates. So although we saw rates come down, we didn't really see that represented in the Canadian fixed income market, which had more muted returns in 2025.
Similarly, real estate often has that inverse correlation, right? Real estate tends to do well in a lower interest rate environment and struggle perhaps in a higher interest rate environment. And what we saw last year, right now, what you're looking at is the Canadian aggregate housing prices across the country, across all types of housing. We saw essentially the 4th year in a row with housing prices cooling and still cooling rather significantly. If I'm not mistaken, it was BMO that just recently put out some research showing that if you account for the fact that over the last few years, inflation has averaged about 3.7% a year, housing prices in real terms are unchanged over the last 9 years. So effectively, the real price in today's dollars is the same as it was in 2017.
And that's really what this chart is showing. The peak there following 2022, from peak to where it is today, would be 22% fall from that top end price. So quite the movement in real estate.
So let's take a look then at how we design portfolios to help mitigate against a lot of this uncertainty, to take a little bit behind the hood. And so today we thought we'd continue this analogy of how do you safely cross the stream during turbulent times, and how does that relate to portfolio construction. So we distilled it down to 4 ideas. 1, making sure that you have multiple points of contact or distributing weight properly as you cross that stream. 2, making sure you're not making any sudden movements. 3, making sure that you pick the safest route, not necessarily the fastest route. And 4, wherever possible, to avoid that major misstep that will lead to a fall. So how does that analogy translate into portfolio returns? Well, quite simply, when we're talking about multiple points of contacts, we're talking about diversification. But there's a few ways that you can think about diversification. The simple way that we often, or other investment advisors like us, will represent diversification is looking at it as a series of different buckets over which you spread your money. And each of those buckets is a different asset class. So as you know, there's the big 3 that most of us are familiar with: cash, stocks, and bonds. Obviously, within each of those asset classes, say like stocks, there's different sub buckets. There's large cap stocks, there's small cap stocks, there's domestic stocks, there's international stocks, and then those of you who have been with us for a while know that we like to try and diversify beyond just traditional investments to private or alternative investments, things like real estate, infrastructure, and a number of other the asset classes that you see below on the right hand side. And that's one way to think about diversification. The other way to think about diversification is to think about the role that an asset class plays in a portfolio. And so when we're building a portfolio, each of the building blocks will have a different purpose. And one of the purposes of part of your portfolio is liquidity. So that means that's the part of your portfolio that is very easily and quickly convertible to cash with limited to no impact on price, right? Almost any investment can be turned quickly into cash, but some investments, you really need your money quickly, you might take a big price discount on it. So part of it.
Think about anyone here on the call that's currently spending some of their investment portfolio. They need to support their income through investment withdrawals. That's your liquidity bucket, and that's why you'll often see that represented in your portfolio as a high interest savings account. That's where we're providing that liquidity.
The next bucket that we think about is fixed income. This is actually the broadest bucket in terms of the purpose it serves. Those of you that were on the webinar, I think 2 quarters ago, remember we covered some of the changes that we made to our fixed income allocation last year. And that's really to underscore the fact that fixed income doesn't necessarily just serve one purpose in a portfolio. It can really serve 3 purposes. One thing that fixed income does is it creates income, right? If you own a mortgage investment or a bond, it'll have a coupon or an interest rate that's paid on a regular basis. That's your income generation component. High quality, shorter duration bonds will tend to be good for liquidity, investments to be sold quickly without much impacting the price. And then certain types of fixed income investments are good hedges against equities. So long-term government bonds tend to do well when equities do poorly. So they can act as that hedge in the portfolio. The third bucket that we think about is your growth bucket. And what is growth? Growth is essentially the idea of outperforming inflation over time. As we saw a few slides ago, the idea that inflation over the last few years had averaged 3% a year. If your money is not growing at that rate net of taxes year by year, even though the dollar amount is going up, your actual purchasing power is going down. And generally in the portfolio, the thing that creates that growth is going to be the stock or the equity part of the portfolio. Then we've got 3 other buckets, which is how we think about the alternative or private parts of the portfolio. And really we categorize them by purpose. So certain types of alternative investments are other complements to income generation, things like private credit, so lending to companies, or asset-backed lending, things like private mortgages, or intellectual property like music royalty or structured notes. There are different ways that we generate income for clients in a portfolio. Then we have the part of the portfolio which is traditionally represented by, the Westmount Real Asset Fund. But it encompasses investments that tend to act as a hedge against equity volatility, as well as providing inflation protection, because some of those assets tend to move in lockstep with inflation, or do well when inflation rises. And really the third part of that is going to be the private equity piece, which is another form of growth. It's where you're hoping to get even better growth over the long term than your publicly traded markets, but it's just another form of growth in the portfolio. So all that to say, when we think about how do you safely cross the river, one of the most dangerous things is to be over concentrated in one sector, or one type of investment, because sometimes that investment is going to really suffer. And so maintaining a diversification, not just on types of investments, but on what components and what they're for in a portfolio, is really important to protecting your money over time.
The next component we'll talk about is no sudden movements, and as the title suggests, it's gradual allocation changes help reduce that major regret when you're going through a market event. And there's no better way to illustrate this than showing the three major markets on the public equity side that we provide exposure to. So we've got the US market in purple, the Canadian market in orange, and international developed in blue. And what we're showing is the performance of those three assets since the beginning of this, or the beginning of 2025 until Liberation Day. So you can see international markets down 10 and US markets down all the way close to 20%, starting with that Liberation Day announcement. Now, one would, based on the headlines that were coming out at that point, that's where one would want to, or be enticed to, make a change based on the magnitude of the tariff announcement that came out. But what we're trying to show you here is, look, if one just stayed the course, this is the return set thereafter. So although it's enticing to want to make large changes as headlines come up, we are often better served to just leave, as Lorenzo mentioned, that growth bucket alone. Let it compound. And the cost of that admission for that higher returns that you're going to get in that asset class is unfortunately the volatility that's associated with it. And that's why you own other parts of the portfolio that can provide that liquidity when you need it, or that current income so that you can take withdrawals from your account.
So when we take a look, for example, at like the cost of panic, last year was really a perfect example of that. When we take a look at, for example, now this is what we're showing on the screen is the gross returns of the core model portfolio. So obviously our clients are invested, very closely, but it's not an exact replication of our core model. And please keep in mind that these are the gross returns, gross of advisory fees, often because each client pays slightly different amounts of advisory fees depending on the assets they have with us. We can't report the net of fee numbers since they wouldn't be represented, but these are the gross of fee numbers. You can see here that essentially from the beginning of the year to where things bottomed out in early April after the announcement of Liberation Day, we saw that core model drop from about 2 to 3% returns up on the year to negative almost 5%. And it was interesting to me as an advisor to see how many calls I got from clients that were very unsettled about, what was happening in April. I've been, an advisor since 2004. So I'm rounding up on 22 years now. And other than 2008, which was obviously a very unsettling period of time to be an investor, the worst stock market returns since the Great Depression, I don't think I've had more clients that were concerned. Not because the magnitude of the losses were great. They weren't. Seeing pullbacks of 5% is almost an annual occurrence in a diversified portfolio over time. But because the headlines and the context of what Donald Trump was doing was so out of the norm, I think the client comfort was so great. And I had to talk, I think, probably 2 or 3 clients off of the ledge in terms of, staying investors, which is, I think, a bit unusual because often, even during COVID, I don't think I had so many clients calling, being concerned about things. And I get it. I certainly get it. And that's, what we're here to do is to provide some context and clarity when things feel uncertain. But, the investor that would have jumped off and decided they couldn't handle that volatility last year, would have missed a really big upside, right? A 17.5% rebound effectively from that low point until the end of the year. And, that just kind of shows you making those sudden movements, especially when things are uncertain, can be very costly over time. So, the other thing we talk about with clients is making sure that you're choosing the safest route, not always the fastest route. Well, what do we mean by that? What we mean by that is that, very often it's tempting for investors to chase the good performances, what asset class has done really well the previous year. And I'm sure many of you have seen one of these asset map quilts over time that effectively shows what was the best performing asset class for
At the top row, down to the worst performing in the bottom row. And really what you see is that leadership changes year over year. So chasing last year's winner doesn't necessarily relate to a good investment strategy. I think what's really important is the light gray area that's kind of undulating around the center of the rows, which says AA, and that's asset allocation, meaning a mix of all of the other assets listed in the column. And really, as Lorenzo said, it's not the fastest route per se, but it definitely is the safest. As you can see, it's got a very consistent return pattern.
I realized as I'm looking at this presentation today that by mistake I deleted the next slide, which is the crux of where this is going. I'm going to see if I can share my tab properly here to fix this. So we just showed a quilt pattern about why chasing the winners is a dangerous concept. And I've over the 22 years I've been an advisor, I've seen multiple versions of this concept. So it's interesting to see a more recently updated one. And you've often seen kind of research that shows, well, what about if instead of maintaining an asset allocation portfolio, so a well-diversified portfolio, I simply at the beginning of every year invested in the investment that did the best the previous year. So what you see in this graph above is 20 years worth of investment returns, and it's broken down by a few different buckets. And each survey maybe chooses slightly different buckets. Here it represents large cap stocks as by the S&P 500, and then uses a bunch of different other subcategorizations of the investment universe. You can see that the idea of the asset allocation portfolio or the well-diversified portfolio is this taupe color here, this like grayish taupe color, which tends to be kind of a middle of the road performer. And of course, at the very top line is the best performers every year, and at the bottom is the worst. And obviously, as you can see, year by year, the best performers and the worst performers are always rotating. But this is the most recent version I've seen of this survey, which I've seen many times over the years. This is basically saying if you took $10,000 every year, and at the beginning of the year, you invested it in last year's best performing asset class. So if you chase the winners, your rate of return over that 20-year period of time would have been 3.67% a year. If you were chasing the worst performers every year, you would have had 2.2% a year return. If you'd simply had an asset allocation portfolio diversified, you would have actually done the best at 4.77. So here is at least, again, another confirmation that at least showing some research behind the idea that just being well diversified instead of trying to chase the winners, tends to be accretive to investors long term. All right, let's get back to the slides. Sorry. And then, lastly here is the idea of, trying to avoid major falls. And, the idea is like, you don't want to be over concentrated in the one thing that wipes you out. And it's related to the previous concept of, investors often, it's human nature. We get excited about something that's performed well. We see our friend that's been investing in cryptocurrency, and maybe they've had a really big run and they tripled their money over a few years period of time. And we start thinking like, oh, hey, how come I'm not on that bandwagon? And it's important to understand the more concentration you have in the portfolio, when things go poorly, the more you can lose. And the more you lose, the harder it is to recover. If you lose 10% in a year, the next year you need an 11% return to break even. If you lose 33% in a year, you need a 50% return. But by the time you go from $100 to $50, if you only have a 50% return the following year, you're only back at $75. You need a 100% return to make up for a 50% loss. So the bigger your losses, the harder it is to recover. So avoiding those major falls is really important. And it's also really important, and I know we've talked about this to most of our clients over the years, is just how most of us are hardwired. 85% of us, the research shows, are risk averse in terms of our personality. That means that we are on average 2 to 3 times more upset to lose $1 than we are happy to make $1. So we're much more affected by, seeing the portfolio down 10% than we are happy by seeing it up 10%. So the biggest danger we can make is jumping off the markets and interrupting that compounding of growth over time, as we saw a few slides ago about how much it would have cost us, that 17.5%, if we panicked and gotten out of the markets in April versus staying invested. So those 4 ways to look basically at how crossing the river relates to making sure that you stay invested properly over the long term as an investor. So Matt, why don't you take us through how each of the core asset classes actually did last year?
Sorry about that. Just as Lorenzo was saying, the winners in 2025 weren't necessarily the winners in 2024. So as we've kind of stacked up what worked well in 2025 on the left-hand side, there wasn't a lot of repeat or overlap from 2024. And one of the best performing assets was gold. But what was really surprising was really a shift away from US leadership, with Canadian International and EM markets all posting close to 30% rates of return. And that's at the index level. And that's really a shift away from what we've seen over almost the last, let's call it 15 years, where we've seen US dominance. So as we kind of work our way through that list on the left-hand side here, it was kind of interesting to see this kind of dynamic play out in 2025. What didn't work, no surprise, was real estate. And that was what we kind of went over at the forefront of this presentation. The other one that didn't quite work out was farmland and timberland, as our agriculture position was hit with some adverse local market effects. But one of the more obvious ones that was a deterrent to most Canadian portfolios that have exposure to US stocks was the depreciation of the US dollar. And relative to the Canadian dollar, it fell about 4.6% over the year. So to put that in perspective for all the clients on this call, because we all consume and spend in Canadian dollars, even though the US index was up, you lost a part of your return to currency as we converted it back to Canadian dollars. So when we take a look at the equity markets first, what you'll notice in the top row is the gray bar, which is the Morningstar category for Canadian equity. Really what we're saying there are all active managers within Canada that try to select securities to outpace the general index would be represented in that bar. And then we can see right below that bar, that light blue area is the investment we use to represent our Canadian equity exposure, which is just done through a low-cost ETF, XIC, which you'll see in your portfolio. Again, same story as last year. We can see the index approach, that low-cost passive way to just get exposure to all, I think it's 217 names in the Toronto Stock Exchange, did slightly, or not even slightly, materially
7%.
outpace active managers. And we can kind of see that across the board here. If you look to the next horizontal bar, we're showing the US equity category versus our 2 US equity positions. The bottom row representing VUN, which is the US total market. That's where we're giving you exposure to US currency and owning the whole US stock market. And then, as Lorenzo said at the beginning of the presentation, EQL.F, which is that equal representation of the S&P 500 with the intention there of reducing the concentration risk in those big names like NVIDIA. And you can see there that equal weight slightly underperforming the category average, but the market cap weight, where the majority of the Mag 7 representation is, outperforming. So again, quite similar to 2024.
And about 2/3 of our exposure there is in the market cap weight, that Vanguard position, at about 1/3 in the equal weight. So, overall, it was an accretive trade for the investors, and very similar on the international equity side of things too, where the Canadian actively managed category average returned about 19% for investors, whereas our Vanguard ETF position, which replicates the FTSE developed market outside of North America index, was up 28%. So overall equity performance last year was excellent, and it continues our philosophy of keeping costs razor thin on the equity side of things and just owning the markets. The only deviation being, a little bit of a hedge there, because the Mag 7 have been such strong performers that we've taken about 1/3 of our equity weight and made it equal weighted, just to take off a little bit of the frothiness from those very growth focused names.
I think it goes back to the beginning of the presentation. What is the purpose of equities or the stock market exposure within your portfolio? And it's really to create that growth and inflation protection. So we just need to let it do its thing, compound over time. And one of the frictions to compounding growth are fees. And that's why we keep that low fee approach for our equity exposure. If we then kind of turn to fixed income or bond markets, you can see, like I said at the beginning of the presentation, even though rates were cut within Canada, that didn't quite really provide that boost that one would expect from fixed income returns, giving a measly 2.6% for the category. And for our fixed income holdings represented by RBC Core Bond Pool, which is more of a global mandate, a little bit more return there through accessing different markets. If we then look at the next row down, we've got more of the corporate credit side. So this means lending out to corporations. You can see that represented by the FTSE All Corp Bond Index, representing or returning about 4.5%. And we've got two positions that we hold in this area of the portfolio. We went over this in our last webinar, but we've got a new position, RP, Alternative Global Bond, which provides more of a hedge or an insurance position within the fixed income part of your portfolio. And it did quite well last year, returning just north of 6%. And then we've got more of a flexible mandate managed by Lysander, producing returns of 3.6%. So more muted returns relative to equities, but kind of in line with long-term yields and expectations for bonds.
The private side of the portfolio was definitely more of a mixed bag this year. Keep in mind that this is data only up until the end of November, because valuations are lagged in private markets, and we're a week or two away from stamping the December numbers for a lot of these. So for the 11 months of the year, the Western Alternative Income Fund, I think, had a strong performance, up 6%. On the first 11 months of the year, delivering that good diversification even in a rate dropping environment, and finding alternative forms of income for clients. The real asset fund struggled, mostly because the real estate portions of that portfolio continued to struggle. However, was counterweighted by some of the other holdings. So overall, in the first 11 months of the year, up 3.5%. What really struggled last year and the year before was private equity. There has been, not a lot of mergers and acquisition activity in the markets in the last few years. There has been, a fair amount of dry powder on the sidelines. And so what we've continued to see over the last 2 years or so is muted returns in private equity. And that's, displayed by the two positions that we have here.
I think we need to go back to purpose. Being in private markets, one would expect to not return the same as public markets. And that's not the intention. The intention really is to provide that stability within that broadly diversified portfolio. So again, the Westmount Alternative Income Fund, creating that high current income, it pays a monthly distribution out for you to spend if you're making withdrawals from your account. The Real Asset Fund, providing that stability within the portfolio if equity markets, that's public markets, start to falter. And then private equity through extended periods of time. You need a time horizon of at least 7 years to be to justify holding a position there, should provide equity-like returns over longer periods of time.
Excellent. One thing we wanted to go over here is, we've been doing reviews with clients over the last few months, and, looking at returns, and, the 1-year returns and the 3-year returns are looking very good right now. And we just want to manage expectations, that over a full market cycle, returns should be a little bit more muted than what we've been seeing. What we're showing on the screen here are the gross of fee returns for each of our models. Again, gross of fee, because each client pays slightly different amount of fees to Westmount depending on the assets that we manage for them. But what you can see here is that the gross returns over the 1 and the 3 years have been, anywhere from about 10 to, high 13%. Obviously, we're very pleased with those numbers, but over the course of a full market cycle, one would expect, a reasonable expectation to maybe be about half, of those numbers on a net basis. And, we never know where things are going to be. We could have another strong year this year, but I think it's important just to, whenever markets are good, to, keep, expectations in line over the long term.
So we're just going to go over just a few reasons for caution and a few reasons for optimism. And these are kind of more forward-looking statements. What could we be worried about moving into 2026? Well, it's, as Lorenzo said at the forefront of the presentation, what if we start to get some of the hot air coming out of that artificial intelligence trade? What if it doesn't create the productivity gains that everyone is assuming that it'll create? And based on the concentration of those names in the S&P 500, representing about 41%, if you started to see a material pullback in expectations, you would definitely feel that in the broad market.
I think we look at the next slide and, potentially also the fourth bullet point there. We saw that on full display this week at Davos with, trade and geopolitical tensions really at the forefront. Obviously, from a North American perspective, we've got the formerly known as the Free Trade Agreement, NAFTA, now CUSMA, being renegotiated. We'll see how that plays out. I am cautiously optimistic that, even though there's a lot of bluster happening south of the border, economics and economics realities tend to, inform decisions. And we saw that certainly when Liberation Day happened, how quickly the administration stepped back on some of their policies after the market started tanking and, bond yields started getting squirrely. So, I think it's going to be another volatile year, but, I think at the end of the day, probably some practical realities of trade will prevail.
I think to Gordon, he just put a question in or a comment in. Everyone says Trump is destroying the world economy, yet I'm seeing great returns. Can you explain? Part of that is just money supply. As we said in the third bullet point or the third theme of 2025, we had the US Federal Reserve cut interest rates 3 times. And that's not just a North American phenomenon, that's happening globally, meaning central banks around the globe are cutting rates. And what this does is it stimulates the economy. Furthermore, we have the big, beautiful bill out of the United States, which is going to put a lot of cash in the US consumers' hands. And ultimately, what that may lead to is the third bullet point here, inflation pressures. And we saw that in portfolios in 2022, where we had a huge bout of inflation. And you can see how the equity markets and the bond markets react to bouts of inflation and a shock to growth. Both of those asset classes coming down, and that's where you really want other parts of your portfolio reacting differently. Furthermore, that broadening of diversification. So you can kind of see here, there's a mixed bag of results here. But to directly answer Gordon, there's also the acronym TACO. Trump always chickens out. And that's really been the theme over the last couple of years. He'll come out with a big statement, but often have to backpedal.
I mean, things that we're looking forward to, that we're, cautiously optimistic about this year. There, could be, especially if inflation rears its head, interest rates could go either way. We could see interest rates increasing, or we could see, if things weaken economically, interest rates decreasing. So that one is uncertain at this point, and will really depend on, how the economy is doing and how inflation rears its head. Corporate earnings have been looking very good this year, despite all of the noise. And so when we talk about, the market's doing well, at the end of the day, the fundamental to all of this is, what are corporate earnings looking like? What are jobs numbers looking like? And those, at least in the North American context, have continued to be pretty good. So yeah, just a few last minute notes here in terms of planning for 2026, since we are starting the new year. We've been reaching out to, clients over the last few weeks. If we haven't gone to yet, please feel free to reach out to us to make any TFSA contributions, first time home
Savings accounts.
Thanks, and thank you for FHSA. Always use the acronym. Contributions, RSP contribution limit this year is $32,490, unless you have some previous unused room. Obviously, RSP contributions as well. And for those of you that are incorporated professionals and are looking to increase salary to maximize your RSP contributions, your salary portion, goes up to almost $200,000 this year to maximize your RSP room. Any last things?
Other than that, I think one of the most important parts about admin is tax slips, because we always get emails coming inbound from clients saying, I'm looking to file my taxes. What we would say is, do not file your taxes until April. Slips can be received all the way in through late April. So we will be posting those through your online portal, and you'll be able to access them in the tax documents folder.
That's everything that we had for today, and we'll open things up to questions.
We got a little comment here on gold and silver exposure. Like I said, precious metals had a tremendous year, gold being up 60% in the year. We do have exposure to precious metals within our portfolios through our ownership of XIC, or that broad Canadian index, with precious metals representing about 14%, materials representing about 14% of that index. And that was really what drove primarily the returns in Canada last year, where it was three major ideas. It was precious metals or materials exposure, Canadian banks, and Shopify. Those three themes generated, I believe, 2/3 of the return. So 20% of that 30% rate of return last year. And that's the nice thing about indexing the markets. We never have to worry about missing an idea because we own the whole market. Capital gains tax. Question here about capital gains tax. Nothing was mentioned in the latest budget about changing capital gains. So we're still at a 50% inclusion rate, which bodes well for long-term non-registered accounts, particularly if you're in the equity markets. The best thing you can do is let that wealth compound, right? Non-triggering those gains. And even if you had to, capital gains being one of the more tax efficient ways to invest your money, where you're keeping about 75 cents on every dollar if you're at the top marginal tax bracket.
Well, we've kept you for 45 minutes today. Thank you for joining us. We'll be sending out a replay tomorrow. If you have any additional questions, feel free to reach out to us by phone or by email. We look forward to talking with you all in the coming months. Cheers.